Chief Investment Strategist for UOBAM Digital Solutions. So here are some housekeeping rules before we begin. The checkbox is available for you to post any questions or raise any connectivity issues to host. At the same time, polls will appear on screen for your selection and the results will be shared. Click onto the Q&A icon to ask questions throughout the session. Click on the like button to upvote the questions if you wish to, and also scan the QR code on your phone to access the feedback form or click on the links available in the checkbox. Today's agenda, we shall cover a quick introduction of the UOBAM Robo Invest. And then after that, we shall move on to the fireside chat between myself and Mr. Dharmo. After that, we'll just cover a little bit on why UOBAM, and we'll end off with the Q&A session. So for a quick introduction of the UOBAM Robo Invest, let's watch this video together.
In forging a sustainable future, we are also glad to work with our like-minded partner, Singtel, to help their customers invest for both profit and purpose. We will continue to expand our range of services and solutions and to work with Singtel to make investing more accessible and sustainable.
We hope to democratize finance by harnessing technology to offer an inclusive suite of high-quality services. And this new investment service delivers on our commitment to make it simple, affordable, and convenient for Dash customers to manage their finances and build their wealth.
Our collaboration with Singtel represents a step forward in the way we offer robo-advisory solutions to consumers. By embedding UOBAM Robo Invest in the mobile wallet, we are providing Dash customers with easy access to professional investment expertise and experience that we have built more than 3 decades.
The UOBAM Robo Invest on Dash is truly a partnership of like-minded people. In partnership with UOB Asset Management, we strive to bring high-grade global investment to customers, which is easy to access from their mobile and at an extremely affordable price.
I hope the video have provided greater insights into the UOBAM Robo Invest and our key value propositions. UOB Asset Management is a multi-award-winning asset manager and financial advisor with over 30 years of investment expertise and over 38 billion worth of assets under management as of 31st of December 2021. We are extremely proud that via our Dash partnership, UOBAM Robo Invest is Singapore's first robo-advisor on a mobile wallet. To deliver maximum value, we have also created sustainable solutions exclusively for our Dash clients. Before we start, probably let's start off with the first poll of the day. Are you currently invested with UOBAM Robo Invest? Please select the answers. Well, thank you everyone for participating in our first poll of the day. So it seems like from the audience, we have about 75% of our audience today have not yet invested into UOBAM Robo Invest, and we will take note of that as well. So before we get started, so hi Dharmo.
Hi, Roger.
Hey, hi. So let's begin with the elephant in the room right now, the ongoing Ukraine crisis. How has it affected our macro views, and probably how would it impact the positioning of our portfolios as well?
Well, I think it is interesting. You're right that it's the elephant in the room. Before it started, I think no one expected that Russia would invade Ukraine. Everyone thought that Russia has achieved its objective in terms of intimidating, and basically with that, there's really no need for that invasion. So it came as a bit of a surprise to us as to why Russia chose to invade. But now that it has happened, I think what we have seen is, of course, a gradual tightening of sanctions on Russia, and to a certain extent, a disruption in terms of production out of Ukraine. I think that has caused a few things. One is, of course, Russian energy, in which that Europe is really very dependent on. That becomes one of the big thing, or a big point of concern. We've seen that with that invasion, energy prices or oil prices went up from 100 to 120. If you are a driver, you probably would know by now that petrol prices have gone up quite a bit. And so has heating gas prices in Europe, and energy and basically electricity prices in Europe. The second thing that has been affected, of course, is really food prices. Ukraine and Russia are major wheat producer, and probably a little lesser known is that Ukraine is also one of the largest sunflower oil producer, right? That's edible oil. And when these are disrupted, basically it has ripple effect on other food items as well, right? So from when wheat is disrupted, it affects your corn, affects your rice. And when sunflower oil is affected, it affects your palm oil, right? So all what we are seeing is really energy prices going up and food prices going up. And these are things that probably would keep inflation higher for longer. Okay, so initially we actually thought that the inflation will probably start easing off by the second half of this year. Now we are less certain, because obviously if this conflict gets prolonged, then inflation could actually last longer than expected. I think that's really one key theme that we want to bear in mind. Second thing is, with this, the concern is really whether Europe would go into a recession. Okay, so basically, what we think is that if energy prices and electricity prices goes up, Europe might actually be tipped into a recession by the second half of this year, or even by the second quarter of this year. And I think that's probably something that has not been discounted, or people have not really factored in. We were initially thinking of a global recovery this year, and an easing of inflation by later half of this year, and maybe into early next year. Now what we might see is really a slowdown or even a recession in Europe, and inflation lasting a bit longer. I think that's really what we think has changed for a lot of expectation as a result of this Russian-Ukraine conflict, right? And because of that, we think that the central banks would probably be a bit more hesitant in raising interest rates. This is the one that's probably a bit would depend on how long this conflict lasts. If this conflict lasts longer, central banks would definitely have to take into account the uncertainty that it brings to the global economy. And with that, basically, rate hikes would probably be less aggressive. I think if you remember in the beginning of the year, the expectation of Fed rate hikes went up significantly. Everyone was expecting 6 to 7 hikes in the early days of this year. I think that number is now brought down to about 4 or 5, simply because there is now more uncertainty in the global economy as a result of this conflict. And so with that, we think that interest rate is probably going to be more range bound, and there's probably a cap, or the risk, the upside risk for interest rate is probably limited. And with that, we think that bonds are actually a pretty decent proposition today.
I see. Thanks, Dharmo, for the the insights. And I guess from our view is that it seems like like you mentioned, right, the food chain kind of is affected. Starting from the wheat producers all the way from the sunflower oil itself, and then going into that. And again, coming from yourself, right, you were saying that our inflation is actually less certain to ease off. Probably it was supposed to last longer than that, and probably into the second half of the year. And I think the interesting point about that is that Europe could be in recession. I mean, there's a big question mark over there due to whatever that's happening right now on the macro perspective. So we've so many things happening at the same time, right? And I guess from a investor perspective, especially those that have already invested into Robo Invest, or even just into investments at this moment, right? How probably to our Robo Invest itself, how would it probably impact in terms of positioning of our portfolios? I do know that from our portfolios perspective, it has been structured from our proprietary capital market assumptions, CMAs in short, and from there, right, do we make any macro changes to it because of what we're seeing, especially with Europe possibly into recession soon? I suppose from that angle, and what's the overall thinking from an investment team per se, coming for in terms of the positioning as well? Yeah.
Sure. I think on the portfolio, we don't have a dedicated Europe allocation. The Euro allocation probably exists in the global allocation. But I think what would have changed, and this is probably part of the beauty of a robo-advisor, is this. As volatility goes up, especially in equity market, volatility goes up. I think we've seen, like, for example, market basically has been whipsawing the last couple of weeks. You see 2-3% move on a daily basis on the S&P 500 or on the Nasdaq, depending on what depending on the news flow of what's happening on the war front. That volatility basically gets translated into our capital market assumption, or our risk return assumption, right? So with that, basically the portfolio, also the algorithm, the robo-advisor would typically reduce the allocation to equities and increase the allocation to fixed income, to bonds, right? That's really to maintain the risk profile, or to maintain the volatility target of your portfolio, or the risk target of your portfolio. So that automatically adjusts and reduce the risk that your portfolio would experience as a result of that, right? So that's really what is happening on the portfolio. And then after that, subsequently, the beauty is that because equity market probably drops off much more than, say, bond market, when the rebalancing comes, the portfolio will then invest into equities as a result of that sell-off, so that we actually buy the market at a cheaper level while selling bonds at a higher level. I think that's really all this rebalancing happens automatically, and basically part of the beauty of the robo-advisor in terms of automatically rebalancing your portfolio for you.
Thanks, Dharmo. I think that's great to know, especially from our audience today, right? I mean, we noted that earlier on, in the poll, we have about 75% of our clients attendance today, right, that are actually not invested in the Robo Invest, and for that, I mean, probably not for today's session, but we probably will share in terms of the QR code that we have put up, the links that we have put up, the audience can actually go onto the website to take a look of how we actually structure the portfolios, and coming from Dharmo himself, right, it seems like our portfolios has actually been positioned and in a way such that we are taking advantage of the current situation. At the same time, when it comes to the rebalancing part, it seems like we are going in. We will be rebalancing into the equity segment when the markets are a little bit cheap. When we realize that that's where the tail off from the volatility. So moving on, right? I guess from that earlier on you just mentioned about the oil prices are heating up. So yeah, I mean in the recent headlines, I mean coming from yesterday, right? Many of us are, I mean some of us that are driving and all that, we noted that right now the prices have gone up to about $3, and that has been quite crazy, to be honest. And prior to that, right, even before the crisis in Ukraine and Russia, we noted that there were actually inflation spikes happening in Singapore as well, and not just in Singapore but also on a global scale itself. And I think you mentioned about the hesitance of the Federal Reserve or even the central banks in general in raising rates itself. So with that, I noted that I mean, it seems like the rate hikes is supposed to be coming down to about 4 to 5 for this year. Again, coming back to the portfolios, I guess, are we prepared for that? Have we prepared for the eventuality? Is that even though there will be rate hikes lesser, but are the portfolios being positioned for that? And if not, from an investing perspective as a client, right? How should we prepare ourselves in the eventuality that the rate hike starts to come in as well? Yeah.
Okay, so basically, to us, the rate hikes are basically part of the normalization process, right? I mean, the zero interest rate environment is really abnormal, because if you have zero interest rate, savers are penalized. If you put money in a bank that you're not going to earn any interest at all, lenders are penalized because of the low rate that you get from lending to other people. Or even like if you think of, if you buy bonds, you're actually getting a very low return, right? So interest rate hike, the sort of the low interest rate environment was partially a response to the COVID crisis, right? In 2020, after COVID, central banks basically cut rates to near zero in order to support the economy. But as the economy recovers, you would have to expect that interest rate will go up, right? We can't stay at zero interest rate forever. Interest rate going up is a normal process as the economy recovers and expands along its cycle, right? So that's the first point. So to us, really the concern is about at how fast would interest rate go up, right? So if interest rate goes up too fast, it causes volatility both in the bond market but also in the equity market. Whereas if interest rates goes up slowly, and arguably sort of the Ukraine-Russian conflict has made central banks more hesitant in raising rates. And if interest rates goes up normally, it's actually healthy for markets. So the market will actually adjust gradually, and equity market can take a gradual increase in interest rates. So long and short is that we think that the interest rate is really part and parcel of normalization and part and parcel of the economic cycle. And the current environment is such that interest rate will not rise as fast, and that's really sort of conducive for market and for investing, right? So that's where we think we're coming from. Inflation, I think the inflation story is probably a little bit more complex. We were expecting that inflation would come off. I mean, this recent sharp inflation, again, was partially due to COVID, right? Because you have supply chains that were disrupted. Some parts of the world are still not open. And when you have certain linkages that has bottlenecks, you create shortages, and therefore it causes price to go up and therefore inflation to go up. The expectation is that as we normalize from the COVID situation, and as economy starts to open up, this supply bottlenecks will go away and inflation will actually start easing. So that's why the expectation is that we initially expect that by second half of this year, inflation will actually start to ease. To be fair, it would probably ease closer towards the 3 to 4% range rather than the less than 2% range. Again, the less than 2% range was really highly abnormal in the sense that it was probably only between 2011, 2012 to 2020 that the world actually saw such low inflation. And people were worried that we are in a deflationary world. Right, by 2016, actually inflation expectation picked up, but it was still roughly speaking about 2%. But if you look at before 2020, the global financial crisis, inflation was actually running at about 2-3%. So we think that it would probably normalize at 3 to 4%. And we argue that the 3 to 4% is because certain things have changed, right? Because people now expects companies to be more mindful of ESG, being more green. And all these actually increase cost of operation, right? Because imagine that you cannot burn coal, which is cheap. You have to use more efficient energy or cleaner energy, which is probably a little bit more expensive, right? So a lot of all these things that even, for example, you in order to be socially responsible, a lot of countries basically wants to increase minimum wage or increase the income of the bottom threshold, or sorry, the bottom quartile of the population. And if you think of it, that basically adds on to your cost because minimum wage goes up, therefore labor cost goes up. So all these probably adds to the cost of business. And therefore we think that operationally, I mean, economically speaking, the world would have to live with about 3 to 4% inflation rate rather than the sub 2% inflation that we are talking about. But once that adjustment happens, probably in 2023, 2024, we might go back towards the 2 to 3% inflation rate that we're talking about. But roughly speaking, that's where we see the picture in terms of inflation. And as long as the long-term inflation outlook is still stable, which so far what we've seen in the financial markets, the indicator shows that the inflation expectation is still well-grounded, then central banks don't really need to hike rates to meet that inflation fear. As long as inflation expectation continues to be grounded, then central banks can actually take its time to raise interest rates, especially if there are uncertainty in the geopolitical scene. Right, so I think that's the long and short. The thing is that inflation would probably start easing, maybe not as soon as we liked, but it will start easing going into next year. And with that, interest rate can actually remain well anchored and would actually sort of increase gradually. And therefore, it is really still a fairly conducive environment for investing.
Thanks, Damo. I think that's very insightful in terms of where we are looking at as a house. And I think the information taken, I mean, it's kind of key takeaways that I've just jotted down, right, for the audience today is that, we look at it, from our standpoint as a UBM, as a house itself, right, we do expect, initially, I guess, the inflation is supposed to be, starting to ease off when the supply chain, is kind of, when the conditions normalize, the supply chain are back to normal. Hence, the inflation is supposed to start to ease off and then come to a general consensus around 3 to 4%, which is the ideal scenario. But I guess, everything that we started to plan and we look forward, it gets thrown out the window, given the current geopolitical situation as well. But I think the last point what you mentioned is quite true. If the long-term inflation outlook is stable, then yeah, to be honest, from a central bank perspective, then they probably they don't need to, they don't have to hike rates to kind of to meet that inflation target itself. So I think that's one of the key points that probably our audience today will have to take note of that as well. So before we move on to kind of the next question, or that Damo that we would like Damo to answer, is that I'll just bring out the next poll in terms of how likely are you going to invest in 2022 given the current market volatility. Yeah.
Wow. I like this audience. Most of you are very likely and likely. I like this audience.
Yeah, I guess everybody in the crowd today are looking at probably looking at opportunities, I guess, and I think probably we'll cover that later on in terms of how the geopolitical conditions that actually may actually favor kind of investment opportunities that we have seen from some of the longer term kind of economic reports from there as well. So let's quickly move on a little bit. So I guess from UOB AM standpoint, I think we have just recently published our first quarter 2022 quarterly investment strategy, in short QIS. And I think one of the key takeaways from the report itself, we talk about slower growth in a mid-cycle expansion. So Damo, could you just probably explain to us and also to the audience, right, what exactly is a mid-cycle expansion? And with the recent geopolitical issues, right, have our views changed? Yeah.
Okay. You see, what do we mean by mid-cycle expansion? So usually we look at the world on an economic cycle, right? We say that the world goes through a normal economic cycle. From a recession, you get a recovery. From a recovery, you get growth, and then inflation starts to pick up and interest rate starts to go up. And then when interest rate goes too high, people start feeling, economic activity starts to slow down, and then we actually start seeing a downturn, and then we go into a recession. So that's what we see as a normal economic cycle. And the world always goes through this economic cycle, right? And what we've seen in the last decades is that each cycle typically lasts anywhere from 5 to 10 years. The average cycle actually lasts about 8 years, right? So when we look at the last recession that was triggered by COVID, in which that, if you think of it, economic activities collapse, right? That COVID lockdown triggered the last recession. And then recovery started in about mid-2020 as government sort of supported the economy, and then later as vaccine starts rolling out and economy starts to reopen, you get that recovery. So think of it, 2020 was the recession, late 2020 going into 2021 was probably the recovery, and 2022, which is where we are now, is probably, call it the second or third year of that recovery. So if we follow a normal recovery cycle, we are somewhere in the middle of it. We are still in the middle of this economic cycle. That's why we term it mid-cycle, right? But what happens is that in mid-cycle, we go from very strong growth to a more moderate growth, right? Because the recovery from 2020 recession, if you look at it last year, global growth was almost 6%, right? So that is really extremely rapid, because 2020's growth, 2020 was a recession. In 2021, we actually saw 6% growth. So that recovery was actually very sharp. This year, the expectation is that the global growth will come down to more like 4%. 4% is actually still above normal growth. Normally, the world grows at about 3%, economically speaking, right? 3 plus or minus, right? This year, we are expected to grow at 4%. So it's still actually above trend, but it is a slowdown from that 6%. So can you imagine if you drive a car at 100 kilometers an hour and suddenly you go down to 80 kilometers an hour? 80 kilometers is actually still very fast, but from a emotion point of view, or from a sensational point of view, you feel that you're slowing down, right? So, and that's what's happening to the world. That's what's happening on the economic front. 4% is actually still very fast, but coming off from 6%, it feels like it's slowing down. And therefore, it creates uncertainty, because people don't know whether this 4% will further slow down, whether it will slow down at a faster rate. And then you couple it with rising interest rate, that when your interest rate is going up, but your growth is slowing down, people feels uncomfortable, right? Investment feels uncomfortable, or investing feels uncomfortable. And that's what we mean by a mid-cycle slowdown, right? It's not really that we are going into a recession, but in a mid-cycle, given that we are slowing down from extremely fast growth, it can be tricky for markets. And what we've seen in markets is basically testament to that. So even before the Russian-Ukraine conflict, in January, we basically saw that market sell off, simply because people are worried about growth, but at the same time, people are worried about higher interest rates, right? So that's really the current situation. To us, we believe a mid-cycle slowdown should still be favorable for equities, although it might be more volatile. So our view is that last year, actually, if you have invested last year, global equity market has done very well. It was in 20+% growth. This year, we are expecting slower growth, or slower appreciation with higher volatility. So it is definitely a more tricky investment environment. And so we basically suggest that you adopt a more longer term view. Don't try to time the market. Don't try to say, oh, it's volatile, I sell, if it's I'll buy when the market hits the bottom. It's very difficult to time that market. We prefer that we prefer to emphasize time in the market than timing the market, right? And we always advocate that if in this sort of volatility, a simple dollar cost averaging, or that you invest a regular sum over time would be a preferable strategy in terms of making sure that you are not whipsawed by the market, and you don't get affected by the emotions, the roller coaster of the market.
Hey, thanks, Dharmo. I think that's quite interesting, because I think from an investor standpoint, right, we have been talking about how the recovery has come in since I think it has been going on forever and ever, since what, 2020, 2010, 2011, 2012, all the way. And I just realized that, we had that recovery. The dip was coming in from around March 2020, and then towards the end of 2020, that's when the recovery started to come in, and 2021 was actually a recovery year itself. So I think the last point, and one of the key takeaways I get it from Dharmo yourself, right, and to the audience today is that our view from that perspective is that it's favorable for equities, even though it's a slower growth environment. But definitely the expected volatility is going to be higher. And with that, right, the expectation, you can't probably have that kind of like higher growth that we are seeing in 2021. So if you unable to time the market, like what Dharmo has mentioned, so the time in the market itself is more important. So yes, dollar cost averaging definitely is one of the age-old strategy that it has been working for ages and ages. And I think if you're looking from the angle, and probably you're not so keen on dollar cost averaging, is also another way is probably on a placement basis. Every 1 or 2 months, every quarter even. In fact, you can actually start to invest into whichever a basket of securities or even a portfolio that you've drafted that you are looking at. So that's where we will actually look at topping up whenever the time comes as well, because I think this first quarter is probably the bonus season. So when it comes to the bonus season, I guess every one of us will be looking at from a personal investing perspective, how should we clear off our existing debts, pay off as much as possible. But from an investing angle, this is actually could be another opportunity for you to look at a portfolio if you hold a long-term view and then start to top it up as well. So thanks Dharmo. I think we are definitely appreciative of what we have gone through. I think just broadly speaking, in terms of how the markets have performed and our view as well. So maybe let's just move on to the final poll for today. And I mean, even though that there are about 75% of the audience today, they have not invested with us, the UOBAM Robo Invest. Perhaps one of the questions that we like to ask, right, is actually, what do you look out for when you want to invest with Robo advisors? Okay, so it seems like everybody is going for performance. So I mean, we are almost coming to the end of the first quarter. So in probably our next update next month, in April itself, we'll be covering the performance of UOBAM Robo Invest. So stay tuned for that in terms of our communication. Just before we go into the Q&A session, right, I just wanted to highlight an ongoing promotion for our UOBAM Robo Invest clients, and for those in the crowd today, they have not they have not started investing with us, probably you should be keen to look at this current promotion that we have with UOBAM Robo Invest. Can we have the slide on that promotion page itself? Yeah, so just a little bit, just to highlight on this is that from now, actually, till 30th of April this year, you simply need to top up a fresh funds of about $500, and you maintain the account for about 90 days. You actually receive $20 worth of credits into your UOBAM Robo Invest account. At the same time, for our Singtel mobile customers, you actually will receive additional 1,000 Dash rewards points given to you. So this is limited to about 350 UOBAM Robo Invest clients. So do scan the QR code on your right hand side, and that's where you start to download the app, and then you go through the information as well. So let's quickly go on to the Q&A session. And I've seen some interesting session or rather some interesting questions that the clients have been asking. So probably I'll just bring out one of these questions, right, is that, would there be any short-term position in oil and commodities or gold? I guess, especially we talked about that just a few minutes ago, right?
Mm.
And since they are the go-to asset classes right now. So maybe Dharmo, do you have any replies on that?
Okay. The robo advisor is meant to invest for the long term. So basically, we don't take trading positions, especially short-term view and short-term trading positions. And arguably, say for gold and oil, these are really trading calls in a sense. Oil and gold doesn't generate an income stream for a portfolio or for an investor. You are basically counting on the price of all these assets to continue to go up. And to us, we really don't know, right? We don't know whether 2000 2001 is the peak of gold price, or it's going to go to 2003 or 2005. So we don't like, in that sense, we don't like to hold on to assets that we can't really predict very well what the value is going to be like in the long term. And then, of course, again, after if the crisis sort of abates, would gold come back to 1800? Again, we don't know, right? So basically, it's a trading call, and the robo-advisors is not designed for this sort of trading calls. So that's what the short answer, long and short answer is no, we don't have gold as an asset class or oil as an asset class in the robo-advisor, because this is really designed more for long-term investment rather than for short-term trading.
Sure, thanks, Dharmo. And I think that's pretty key as well. I think you brought up the good point about where our stand is in terms of having a robo-advisor, which is actually a long-term view on that. And probably let's just quickly move on to the next question. I think this is actually quite a good question as well. So for the members of the audience today, right, just to educate a little bit on that, is that UOBAM Robo Invest, right, we actually have an ESG theme portfolio. So for those who are unsure, you can actually go to our website, the UOBAM Robo Invest website itself, and then you probably can find out a little bit more in terms of the ESG portfolio. But pertaining to this question, right, by having a ESG portfolio, would this also mean that you'll be less affected by the current commodity prices surge, even though we don't have that as an asset class, but probably on a general basis in terms of how the macro economic, the view, the macro environment is going at this moment, right? Will the ESG portfolio be affected by that? Yeah.
Okay. So if you think of it, the ESG portfolio generally would, in the past, if you think of an ESG portfolio, you realize that an ESG portfolio would not have too many investments in energy stocks, right? Your oil producers, your coal producers, or your mining companies are not really really what you think of if you think of ESG. So an ESG portfolio, if anything, tends to underweight energy and tends to underweight material. And in this environment, when actually your commodity prices is rising very fast, these companies, these mining companies, oil companies have actually held on much better than the broad market. So if anything, an ESG portfolio may underperform in the short term. Okay, and we will not apologize for that. The thing is, the value of an ESG portfolio for us, we always say, is that we want an investment portfolio that is sustainable in the long term, right? And we know that the environment cannot take us burning fossil fuel like we did in the last several decades or last century. So to us, having an ESG portfolio is something that we need to do for the good of the long term, as well as we think that a sustainable company would probably be would have less risk going forward, right? Imagine before this Ukrainian conflict, if you own oil company, you worry that these oil companies may not be able to produce oil in a few years down the road when there is when everyone don't want to burn fossil fuel anymore, right? The company's viability may actually be at risk going forward. So really, what the portfolio is trying to do is have companies that invest in companies that are sustainable, and that's basically the objective. So in the short term, the sort of spike in oil price and spike in commodity price, if anything, would actually make the portfolio less attractive, or may actually make it perform slightly worse than the market. Right. So, but as I said, this is short term. We are really investing for the long haul, and in the long haul, we want to stay with sustainable companies, so that it actually reduces the risk of the portfolio, because there is less risk that the company would blow up because of ESG issues.
Yeah, thanks, Damo. I think that's quite an important point that we have to reiterate over here as well, and probably leading up to that, right, or following from there, right. This other question I think is fairly is quite good as well. So what is your view on the emerging market as well on the whole? Probably, I think the question was asking relating to financial instruments such as bonds, funds, and stocks. But I guess when every time when there's a flight to safety and when there's a market volatility and when people are feeling jittery in terms of the market conditions, and EMs actually usually tend to underperform because EM is considered to be risky, high risk, and probably what is our view on that as well?
Okay. Interesting. I mean, obviously, yeah, usually when people becomes risk averse, EM sells off and everything. But the interesting thing about this time round is that, if anything, okay, EM obviously is not homogeneous, right? Today, if you are Central Europe, there's probably going to be a little bit more concern. We mentioned that Europe might go into a recession, and if you are Central or Eastern Europe, then you feel that impact, right? But if you look at some countries, for example, Asia has actually sort of been more isolated from that conflict, and we are basically levered more towards, say, China's growth, and given that the Chinese government is trying to stimulate the economy now after tightening it last year. Remember last year, there's a lot of regulatory tightening, right? Clamp down on private education company, clamp down on technology company, internet companies. This year, or starting last year, we are actually starting to see the Chinese government trying to ease, right? They cut interest rates, they start pumping more money into the system. So Asia tends to be more levered towards China's growth, and we actually feel we are actually more insulated from what's happening in Ukraine and Russia. And if anything, Chinese RMB have actually remained very, very strong in this environment, right? So that's why emerging market is really not homogeneous. If you look at it, some emerging markets like Brazil is doing very well because it is an major oil producer as well. So it's benefiting from the higher commodities prices. Obviously, there are some emerging markets that will feel the pinch, but currently what we've seen so far is Indonesia is doing well because they're exporting palm oil. Malaysia is doing well because it's exporting both palm oil and oil as well. And what we've seen is generally Asia and LATAM has fared relatively decently. It's really more the Central and Eastern Europe that's probably feeling the strain. So yeah, I guess it's a mixed story. It's kind of difficult to really paint emerging market in one broad stroke.
Yeah, thanks, Damo. Yeah, I guess from that angle, it's more of that. Probably there's a different pole ends in that sense, whereby one end of the EMs are actually doing much better, I guess, and then the other end of the EMs are actually feeling the heat coming from what is happening in Russia and Ukraine as well. So maybe just in the interest of time, then I mean, one of this question that I was asking you earlier, right, is that from what I've seen and some of the graphics that's been going around. Some of my friends have been sharing this as well, is that how have the previous geopolitical incidents that affected the global markets, right? I've seen some graphics saying that geopolitical tensions actually do not have any significant impact in the global markets on a longer term basis. I mean, in the short term, everybody knows that it's not great, but from a longer term perspective, probably let's say 2 years or even 3 years kind of outlook, right? How have that actually would that actually have a significant impact in terms of the global markets? And yeah, any views on that?
Okay. This might sound a bit obscene. Okay, geopolitical conflicts destroys wealth in the area that it is happening, right? If you're involved in a war, your wealth is destroyed. So that's usually the case. But in other parts of the world that's not affected directly by the conflict, if anything, past histories or past cycles tend to suggest that usually that's the time to buy. That's the time to buy the market. That's the time to invest. I think the old adage is, buy when there's blood in the street, right? So that's basically a very crude way of saying, but that's really what it is, because if anything, this sort of sell-off usually are buying opportunities, because markets tends to go look past it very quickly, right? And in fact, if you think of it, the past episodes, the longest bull market that we've ever seen started during the first Gulf War in 1991. Right, from 1991 up to 2001, that 10 years was a huge bull market, including even during the Asian boom then, right? Basically the second Gulf War, if you think of it, is also positive for markets. So really, geopolitical conflict usually has very little bearings on markets, and if anything, a sell-off during those sort of conflicts is probably a good buying opportunity, right? And if you think about it, in war, there is a lot more. A lot more things are consumed and produced, and that is actually really stimulative for the economy. And basically, that's usually good for the economy. As I said, it sounds a bit crude, but that's the fact of life in the financial markets.
Thanks, Dharmo. I think that's really clear, and I think that probably round up in terms of where we've been chatting for the past 30 minutes or so, and all that, in terms of how the markets have performed, what are the key risks out there, and what has been happening around the world, and how has it impacted some of our portfolios positioning, and also from our house view itself, what is our macro view, how do we view inflation, how do we see the Fed rates and any potential rate hikes as well. So in the interest of time, unfortunately, we have to end today's session, and we'd like to thank you for attending today's webinar. We do value your feedback, so please click onto the feedback link found in the chat box for the feedback form as well. And lastly, special thanks to Dharmo for taking time to speak to us today. So to the rest of the audience, have an awesome day, stay safe, and goodbye.
Bye-bye.